Regular candlestick patterns fail 80% of the time without volume confirmation. My price action trading completely changed once I discovered the power of volume candles. These candles expose institutional order flow and show you exactly where smart money is placing their orders. Let's talk about it. Trading becomes clear when you strip away all indicators and focus on what truly moves markets: pure price action and volume. Price action alone misses crucial market information. You might see a price move up or down, but without volume, you can't tell if that move carries real weight. Volume fills this gap. It acts as the only true leading indicator, revealing market direction before big moves happen. While price tells you what happened, volume shows you if that move was real or fake. The iconic traders of the past, Charles Dow, Jesse Livermore, and Richard Wyckoff, used this simple yet powerful approach. They didn't need fancy indicators or complex systems. They understood that the combination of price and volume revealed everything about the market behavior. Clean charts let you spot things that indicators often hide. When you remove all the clutter, you start seeing the market's natural rhythm, and volume adds depth to this view. It shows the strength or weakness behind every price move. Volume works as the truth teller in markets. When you see a price move, volume instantly tells you if that move deserves your attention. High volume means many traders participated, giving the move more credibility. Low volume suggests weak conviction and possible fake moves. 99% of traders tend to overcomplicate their process, but the market hasn't changed in over 100 years. Volume and price still drive all moves, and volume candles paint a much clearer picture of market strength and buyer-seller activity. This type of chart allows for a visual assessment of the volume of trades for each candle. These are still candlesticks, but the width of each candle depends on the volume of trades during the formation of this candle. The greater the trading volume during the formation of the candle, the larger the width of the candle. A volume candle holds 7 critical parts that tell the full story of price movement. Let's break down each element and show you how they work together. Every volume candle has an open price, which marks where trading started in that time period. For green candles, you find this at the bottom of the body. For red candles, it sits at the top. This starting point sets the stage for the battle between buyers and sellers. The high price shows the maximum point buyers push during that period. You see this at the top of the upper wick. This tells you how far buyers managed to drive prices up, even if they couldn't hold those levels. The low price, marked by the bottom of the lower wick, reveals the lowest point where sellers drove the price. These extreme points show you the full range of the price battle that happened. The close price tells you who won that period's battle, buyers or sellers. On green candles, you find it at the top of the body, showing buyers won. On red candles, it's at the bottom, meaning sellers took control. The upper wick, that line sticking up from the body, shows rejection of higher prices. A long upper wick means buyers tried pushing up but failed. No upper wick signals strong buying pressure that held through the close. A long lower wick reveals sellers tried pushing down but failed. When you see no lower wick, sellers maintained control throughout the period. The candle body, the thick part between open and close, shows who won the period and by how much. A wide body means strong conviction in that direction. A narrow body points to weak conviction or indecision. Now, what makes volume candles special is their width variation. Unlike regular candles that stay the same width, volume candles grow wider or narrower based on trading activity. This adds a vital dimension to your analysis. Wide candles mean heavy trading volume. Lots of buyers and sellers fought over prices during that period. Narrow candles show light volume. Fewer traders participated. This width variation reveals trading intensity at a glance. The relationship between candle parts tells deeper stories. Take a wide candle with no wicks. This shows strong agreement on price direction with heavy participation. But how about a wide candle with long wicks? That reveals intense fighting between buyers and sellers. Watch how the candle width changes as price moves. Increasing width during price rises shows growing buyer strength. But if the width starts shrinking while price still rises, buyers might be losing steam. The open and close positions relative to the total range matter too. A close near the high with wide volume suggests strong buying pressure likely to continue. A close far from the extremes with high volume might signal indecision. Some traders focus only on candle colors or patterns, but volume width adds crucial context. A tiny green candle with huge volume might mean more than a large red candle with thin volume. Pay special attention to how volume width changes around key price levels. A surge in width near support or resistance often signals important market decisions happening. We'll talk about this later. The real power comes from reading all these elements together. Each part adds to the story, but the volume width ties it all together by showing the conviction behind every move. The beauty of volume candles lies in their ability to show both price action and trading intensity in one clean visual. This complete picture helps you make faster, more accurate trading decisions. Stop looking at single candles and start seeing the market as a flowing story, where each candle connects to the next. A green candle might signal buying, but its true meaning changes based on where it appears, at the start of a trend, in the middle, or near the end. The market moves in phases, not in isolated events. The same type of candle carries different weight, depending on its place in the overall flow. A wide green candle at support means something very different from the same candle at resistance. Think of price movement like reading a book. You wouldn't try to understand a story by reading random sentences. You read them in order. The same applies to candles. Each candle flows into the next, creating a complete narrative. Price trends develop and validate themselves through this continuous flow. Take a series of rising candles. As they form one after another, they confirm or deny the strength of the move. The story becomes clearer with each new candle. 3 consecutive up candles with growing volume show rising strength. This tells a story of building momentum. The flow reveals more than patterns. While a single candle might show buying pressure, the flow shows if that pressure sustains or fades. This continuous view helps spot genuine moves from fake ones. You see, smart money leaves footprints in this flow. They don't act in single candles, but across a series of moves. Reading the flow helps track their actions and intentions. Each candle connects to the next, creating a rhythm. Breaking this rhythm often signals important changes in market direction. Volume doesn't just validate single candles, it validates entire moves. Rising prices should see rising volume in a healthy trend. When analyzing flow, consider the whole context. A candle that looks bullish alone might actually signal weakness when viewed as part of the larger movement. This approach helps spot reversals early. Volume candles act as market truth tellers, exposing the real story behind every price move. The first rule to spot genuine moves is simple. The volume must match the price action. A strong price rise needs strong volume to prove it's real. Take a wide up candle with small wicks. The high volume shows many traders joined in. proving the move has real support. This matches the basic rule of effort versus result. Big price moves need big effort shown through volume. The opposite situation warns you of fake moves. Picture a price rising with thin volume. This mismatch rings alarm bells. If a move lacks the volume to support it, smart traders stay away. Low volume means few traders believe in the move. A narrow body candle with low volume tells a different story. If price barely moves and volume stays low, that actually validates the quiet period. Volume reveals if moves come from buying or selling pressure. Look at a series of rising candles with growing volume but no wicks. This can only mean buying volume. Sellers aren't fighting back at all. Such clean moves with rising volume signal genuine buyer strength. Widespread candles need matching volume. If a big price move happens on a weak volume, that warns you of potential manipulation. Real moves need real participation. Let's break down a typical false move. You see price shooting up with a long upper wick but tiny volume. This screams warning. Despite the high price, few traders joined in. The small volume exposes this as likely manipulation. True strength shows in the details. When price rises steadily with each candle wider than the last, volume also increases. This rising volume confirms more traders join with each push higher, validating the whole move. Look for volume that matches candle size. Big candles need big volume. Small candles match with small volume. When these don't match, something's wrong. This simple check helps avoid false moves. Also, don't trust wicks without checking their volume. A long wick might look like strong rejection of price, but low volume means that rejection lacks conviction. Strong rejections need strong volume to prove many traders acted. Volume patterns tell deeper stories. Rising price with falling volume, meaning thinner candles, warns of weakness. Falling price with rising volume, meaning wider candles, shows real selling pressure. These volume shifts often signal important trend changes before price confirms them. Always remember that smart money leaves traces in volume. They can't hide their large trades. When you see wide volume candles with small price moves, big players might be quietly accumulating or distributing. These volume hints reveal their plans. I repeat, price action can lie, but volume tells truth. Market makers can push price around temporarily, but they can't fake real trading activity. This makes volume candles one of the most reliable tools for spotting genuine market moves. And watch how volume reacts at key price levels. Strong support or resistance need strong volume candles to break. Thin volume candles at these levels often means the break will fail, no matter how good it looks on price alone. At a key level, when in doubt, volume candles hold the answer. Price action might look perfect, but without supporting volume, they often fail. So, narrow candles with low volume show weak market interest. Wide candles with high volume reveal strong conviction. Let's start with narrow spread candles. This form when price moves very little during the trading period. If this happens with low volume, if they are thin, it actually makes perfect sense. Small price movement matches small trading activity. Large spread candles tell a different story. When price moves far in one direction, creating a wide candle, it has strong volume to prove it's real. A wide candle forms from lots of buying or selling, and the high volume validates that activity. A small but wide body candle means unusually high volume. This warns you something big might happen soon. Think about it. Lots of trading, but little price movement means big players might be quietly building positions. Watch closely when you see large body candles with thin volume. This mismatch sends a clear warning. The price move lacks real support. Despite the big price change, few traders joined in. Such moves often reverse quickly. A series of narrow candles with falling volume often signals a coming breakout. The shrinking volume shows fewer traders want to trade at current prices. This pressure builds until price must break out to find new trading levels. Volume intensity affects how you read wicks too. A long upper wick usually signals rejection of higher prices, but this only counts if the volume matches. High volume with the wick proves many traders rejected that price. Low volume means the rejection might not stick. Volume intensity helps spot trend changes early. A series of large spread candles with falling volume warns of weakening momentum. Even though price still moves strongly, the dropping volume suggests the trend might soon end. Location also matters when reading volume intensity. A narrow and thin candle at support might just mean quiet consolidation. The same candle forming at resistance could signal failing momentum before a reversal. Also, track volume intensity changes over time. Rising volume with wider candles confirms increasing market interest. Falling volume with narrowing candles shows dropping interest. These shifts often predict big moves. Smart money leaves clues through volume intensity patterns. They often accumulate positions using many narrow candles with steady volume. Then they push price hard with a few high-volume wide candles. Spotting these patterns helps you trade with the big players. The relationship between candle spread and volume intensity reveals market psychology. Widespread, high-volume candles show strong agreement about price direction. Narrow spread, low-volume candles show uncertainty or disinterest. These volume intensity principles will definitely help you avoid false moves. The volume candles at support and resistance levels tell a story about future price movement. Wide volume candles at support or resistance signal strong interest. A wide green candle with high volume bouncing off support shows buyers stepping in with conviction. A wide red candle with high volume at resistance indicates sellers taking control. Thin volume candles at key levels need special attention. When price reaches an important level but produces narrow candles, it shows hesitation. This often precedes a false break or reversal. Picture price approaching a resistance level. If the candles get thinner with lower volume, the break attempt might fail. The change in candle width as price tests a level also matters. Wide candles turning into thin ones suggest momentum loss. At resistance, if candles start wide but shrink while testing the level, it warns of weakening buying pressure. Watch for clusters of thin candles at key levels. These often form right before a strong move. Think of it as pressure building. The narrow range shows neither buyers nor sellers want to commit until the break happens. Multiple tests of a level create patterns in candle width. First test might show wide candles with high volume. Later tests often show thinner candles, but don't ignore these. Sometimes the quiet approach leads to the real break. Support breaks need proper volume candle confirmation. A break with thin candles raises doubts. Look for wide candles pushing through the level, showing real selling pressure. The width of the candles tells you if sellers mean business. Market structure changes show through candle patterns. A series of wide candles breaking a trend line or a key structure level carries more weight than thin ones. The width shows conviction in the structural change. Price congestion zones create their own key levels. Notice how candle width changes in these areas. Wide candles pushing into congestion often fail, while patient accumulation with thinner candles might succeed. The character of candles shifts at major levels. A trend of steady wide candles might turn into erratic thin ones at resistance. This change warns of possible trend exhaustion. False breakouts often start with thin candles. Even if price moves beyond the level, narrow candle width suggests lack of commitment. So wait for wide candles to confirm the real break. Volume candle width helps spot distribution tops. At resistance, rising price with shrinking candle width warns of weakness. Big players might be quietly selling into the move. Support and resistance lose strength with each test, but watch how candle width evolves during retests. Widening candles show growing interest. Some levels hold special weight, like weekly highs or lows. Expect wider candles at these points, as more traders watch them. Thin candles at major levels often precede violent moves. Market memory also creates support from old resistance. When price returns to these flipped levels, compare current candle width to previous tests. Similar patterns often produce similar results. The stopping volume pattern shows as a single wide candle. It appears at key levels, often with a long wick. This candle type signals strong rejection. Price congestion creates natural support and resistance. Study how candle width changes when price enters and exits these zones. Wide candles leaving congestion often start strong trends. Momentum loss shows through candle width changes. As price approaches resistance, watch if candles get thinner. This gradual weakening often precedes reversals. Supply and demand balance shows in candle patterns. Wide candles mean strong imbalance. Thin candles suggest equilibrium. Key levels often flip when this balance shifts dramatically. Time frames affect how you read candle width. A wide candle on a daily chart carries more weight than on a 5-minute chart. So match your analysis to your trading time frame. The market structure creates its own key points through swing highs and lows. Watch how candle width behaves at these natural levels. They often work as well as traditional support and resistance. I hope you see how price action becomes more reliable when candle width confirms it. A resistance break with wide candles and high volume shows conviction. The same break with thin candles might trap traders. Volume candles give clear signals for entering and exiting trades. I said it before, wide candles show strong market commitment. But when a wide green candle engulfs several previous red candles, this signals potential buying pressure. The opposite happens when a wide red candle swallows prior green ones. Pin bars with extra width need special attention. A pin bar is like a rejection stick. When it's wider than surrounding candles, the rejection carries more weight. Look for these wide pin bars at key price levels, especially if they come with high volume. Entry timing improves by watching the candle width progression. If candles get progressively wider during a move, it shows building momentum. This often leads to stronger trends. The width increase confirms price direction. Exit signals often appear as reversal candles. When a strong trend shows wide candles in one direction, watch for an opposing wide candle to signal potential reversal. The wider the reversal candle, the stronger the signal. Of course, false signals need filtering. Not every wide candle means action. Look for confirmation from surrounding price action and volume patterns. Single candles rarely tell the whole story. Time of day affects candle width interpretation. Market opens or closes often show wider candles. These times need different analysis than mid-session trading. The first hour of trading deserves special study. Wide candles during this time often set the day's tone. But be careful, early moves sometimes reverse quickly. Risk management also links to candle width. Wider candles often mean more volatility, suggesting wider stops. Adjust position size accordingly to maintain consistent risk levels. Trend confirmation uses candle width patterns. A sequence of widening candles in the trend direction supports continuation. Thinning candles might warn of weakness. Price gaps between candles need attention. Wide candles after gaps often signal continuation. But watch for reversal patterns if volume doesn't confirm the move. Counter trend signals need extra confirmation. A wide reversal candle against the main trend needs more support than one moving with the trend. Pattern recognition improves with practice. Start by marking white candles on your charts. Notice how they cluster at important points and what follows them. My go-to signals using volume candles include engulfing candles and pin bars. A bullish engulfing candle happens when a green candle completely covers the body of the previous red candle. This shows buyers taking control with force. The real power comes from volume analysis. Here you see a bearish trend with several small red candles. Then suddenly, a large green candle appears, with volume much higher than the average. This green giant engulfs previous red candles. That's not just a reversal signal, it's a strong sign of smart money stepping in. Volume candles tells if the engulfing move is real or fake. Small candles with low volume followed by a wide engulfing candle with high volume shows real buying pressure. Smart money likes to move prices when other traders least expect it. A pin bar looks like a hammer. It has a long wick and short body. But volume makes some pin bars more special than others. A pin bar with much higher volume carries more weight than regular ones. It shows strong rejection of a price level. Take this example. The price drops for several candles with thin red candles. And right here, you see a big pin bar, wider than the previous candles, with a long lower wick. The volume on this pin bar is higher than normal. This isn't just a pin bar, it's smart money entering. You see, professional traders don't just look at the candle body size. They combine it with volume study. A thin pin bar with low volume might be a trap, but high volume confirms real market intent. During consolidation, you might see small candles with average volume, then breaks out with a wide engulfing candle and big volume. This shows institutional players making their move. Volume shifts during the day matter too. An engulfing pattern at market open needs different volume than one at midday. Morning sessions often have naturally higher volume, so adjust your expectations. Remember older price zones when studying these patterns. A pin bar at previous support showing higher width and volume carries extra significance. The market remembers these levels. A wide red pin bar with high volume at resistance often signals selling pressure. The opposite happens at support. Green pin bars with volume can mark bottoms. Several narrow candles followed by a wide engulfing one shows building pressure. If volume rises with each candle, the signal gets stronger. Narrow candles with low volume followed by a wide engulfing candle often trap retail traders. So look for volume spikes with engulfing patterns. A bullish engulfing candle erasing 3 prior red candles shows control shifting. This move could be significant. These setups often lead to sustained trends. Wide candles engulfing multiple prior bars show decisive action. And of course, pattern recognition improves with practice. Now, if you want to learn other price action and volume strategies, go ahead and watch one of these videos next.